Hey everyone, Ian King here, editor at Banyan Hill Research with your weekly market insights video. This week, I've got my friend and colleague, Jeff Yastine joining me. Jeff, how you doing?
I'm doing good, Ian. How are you?
Good, great to see you. And before we get into this week's webinar, I just want to remind you, please subscribe to our video channel by clicking the subscribe button right there. If you like the video, go ahead and give us a like. Of course, don't give us a dislike. And finally, if you have any comments, please just type them in below the video and we'll be sure to keep them in mind and get back to you. So this week, Jeff, I know the thing that really is on everyone's mind is this coronavirus. And we've seen this thing really spread in China. It started in a city called Wuhan with 11 million people. There are a number of other cities in China on lockdown. What do you think the risk is right now for the market, and how do you see things playing out right now in the financial markets because of what's happening with this coronavirus?
Sure. I think the market needed a correction, as we saw it move higher and higher from through January. So if it wasn't the coronavirus, it would likely have been something else that would have caused the market to sell off. So right now, regarding this coronavirus situation and the market in general, it's going through this discounting process where it's selling off bit by bit, and it is discounting the worst, whatever that is, of the coronavirus situation. World health authorities are on top of this thing. It will probably continue to spread to some degree or another, but the important thing for investors, I think you have to keep in mind is the more it gets talked about, the more it's in the headlines, at some point it ceases to worry the market as much. And that's the point where you want to start looking to buy stocks. And by the way, Ian, I want to say you were right on the money. When we talked last week, you were talking about your concerns about airline stocks getting hit hard, and some of them certainly have if they service hubs in China or Macau, the big gambling capital in China. That also gets a lot of airline service. So my congrats to you on calling this in many ways.
And thank you. I mean, also, I think the cruise lines have been hit as well. We talked about a story where there's a Carnival cruise ship with 7,000 passengers on it, and there's potentially a passenger who has coronavirus and it's on lockdown right now. I mean, to me, that is like my worst nightmare. I'm a hypochondriac as it is, so being on a ship where there's this contagious virus is like, I really feel for all those passengers right now, and hopefully
Sure.
they can all.
By the way, I want to say that I believe it turned out to be a negative report. Those passengers turned out to be negative, but certainly the cruise ship stocks have all corrected in some part just because of the natural feel of the correction itself. But the coronavirus situation, the norovirus is always something that tends to be prevalent on these ships as well. So you have to look at it as that's the reaction, but is there an opportunity to buy, because a lot of these stocks get knocked down on this bad news, and as investors you need to be thinking, cultivate that habit of opportunity, even though obviously we're talking about a very negative and very serious and fatal situation for a couple hundred people in China so far.
Yeah, and I just want to go over this statistics I got from Statista. I want to pull this up right now for our viewers. How contagious is the coronavirus? And this really compares the number of people infected by an individual with the following. Obviously, measles and smallpox, polio are very highly contagious. So far, what we know about the coronavirus is it's actually less contagious than influenza and a little bit more contagious than Ebola. Now, we don't know if this virus is going to mutate as it grows or it'll change, but right now, I know the World Health Organization has declared a global emergency, but it looks like it could be about as bad as Ebola. I'm more concerned that it's coming from a part of the world where there's a lot more people. And the other risk, I think, is that you're talking about the world's second largest economy shut down for the first time. And I don't know how you price this risk and how long this is going to last, but China essentially is on lockdown with about 2/3 of their economy, or in those cities, not able, people can't get in and out, goods can't get in and out. So I really don't know how this is going to play out, but I mean, the positive is we know that central banks are standing ready to provide liquidity to the markets. And, something that you and I talked about, I know that you view the Chinese central bank as being ready with their fiscal policy and ready to really
Right.
spur the economy. So that could be positive later on this year, right?
It could. I mean, I think it will. Basically, it's a typical central bank response when, the national economy in a country like theirs, the same thing here, the central bank will lower interest rates and do other things within the banking system to make it easier to facilitate, liquidity essentially to help support the economy and the local stock market. So I expect that we will see that happen in China, and the impact for investors, I believe, will be, a big one, a big positive one as we move through the second half of this year and likely on into 2021. So that's where you need to sort of play the long game on these things. Don't think about the immediate headline and worry so much about that. As an investor, think about where all this is going to be 12 months, 18 months, 24 months out. I mean, what's your view, Ian?
Yeah, I know you've been saying since earlier this year that the market is just headed for a pullback, one reason or another. I don't think anybody could guess that it was this, snake, bat, human virus that was going to be the tipping point for this. But I'm sure there are no Wall Street strategists that predicted there was going to be this virus in some city in China that no one had ever heard of before it materialized. But I want to bring up another chart for our viewers, and we're looking at the FOMC rate hike odds. And this is a chart basically of where the market is pricing rates at the end of the year. And what's most significant about this, if you look at the bottom of the chart, I put two red circles here. A month ago, there was a 9.9% chance that we get a 50 basis point cut. Right now, there's a 31% chance that the Fed is going to cut rates by 50 basis points in 2020. And, we saw this in 2019 where the Fed in late 2018 went from rate hikes to rate cuts, and look what the market did. It was up 30%. So I think this is something investors really have to keep in mind, because if we do see any economic weakening or this coronavirus lasts longer, the Fed is already prepared, or investors are expecting the Fed to be cutting rates ahead of any economic slump. So I think it's good for stocks.
And, the thing, I know you talk to your subscribers about it, and for my subscribers, Total Wealth Insider, Ian, I think the key thing here is, as we discuss this possibility of a Fed rate cut, this is something, I talk about to my subscribers, Total Wealth Insider, all the time. Markets and stocks move up or down in anticipation of future events. And so in a correction like we're seeing, whether it's, a couple of percent or 5 or 10%, the market turns and moves higher. Often people are like, I can't believe, why would the market be moving higher? And this is an example of why it would be moving higher, even if the Fed hasn't actually cut rates. It's the market anticipating that is going to happen. And that's good enough for the market at that point. So I would agree. And I would think that if you're in the market, it's yet another example of why you want to stay in the market and remain bullish despite this correction that we're seeing right now.
And speaking of future events, 2020 is an election year, and we are 11 months away or 10 months away right now from deciding whether or not Donald Trump will keep the presidency or someone else, a Democrat, will take the office. Now, something came up recently where Bernie Sanders is actually leading a couple of these nationwide polls on the Democratic side. And I know I read a couple market strategists recently who said that you can expect a 5 to 7, maybe a 10% pullback if Bernie becomes the Democratic nominee. Jeff, how are you thinking about this risk of a potential Bernie Sanders presidency? And how should investors kind of think about it? And what sectors should they be avoiding or potentially buying now?
I wouldn't be making too many investment plans based on a Sanders candidacy or a Trump re-election at this point. I think it's still early, but I think the key is, and the part we don't know, so I can't really answer your question in many ways, but the part we don't know is, what does the market think about this And for all we know, like the pullback we're seeing now, how do we know that some of that isn't actually discounting the impact of a Sanders candidacy as the front runner coming out of the conventions? We don't know. And so we also don't know, in terms of the market's reaction here, if the polls indicate that Sanders is going to be in trouble with his campaign versus Trump, could the market sell off? Yes. On the other hand, you could just as easily argue that the market might accelerate higher if only anticipating a Trump reelection, which I know many on Wall Street, are in favor of. So, that's the thing. You just gotta kind of clear your mind and think about it in terms of just riding it like a surfer, knowing that you're buying individual shares of companies, and that's the key element here. The rest, I think, will sort of take care of itself.
Yeah, I would also add to that we've seen this before. The market sold off ahead of Donald Trump's inauguration. It sold off ahead of Obama's inauguration. So we've seen this kind of play out before, where people freak out because there's a new administration and there's a little bit of uncertainty there. But the market just continues to go higher because I really think that the office is bigger than the person who's in it. And likely, if we do get a Bernie Sanders presidency, we still have other levers in Congress, the Senate, the House of Representatives, obviously the Supreme Court, where it's not like he can just reform the entire U.S. economy in his first term. So I think it could be a really great buying opportunity if we have a panic over, a Bernie Sanders or Elizabeth Warren type Democratic nominee. And I don't think they'll win in the general either. So you can kind of think about that as well, even though they're probably less likely chance that they beat Trump rather than having a Biden or a Klobuchar or, Mike Bloomberg running as a moderate against Trump. So a lot to watch this year.
The key thing I would just say is that just kind of separating the political side of it is just that whether there's a Sanders candidacy, some other Democrat, or Trump in a landslide, we could just as easily see the market sell off in anticipation of 4 more years of Trump. We can attach almost any sort of excuse to a sell-off that we want to. But the key thing is, if Sanders does win the presidency, the chances you're going to see opportunities, not just in a correction, if our presumption is correct, but there's lots of other stocks that you could buy. Like, we've talked recently, was it last week, I think it was, about the possibility of an infrastructure package of some kind. So again, there's a whole round of different stocks that you can buy. Think about it in terms of stocks. It's my message to people, not so much about the market. And you have all kinds of opportunities out there, regardless of who wins the White House in November.
That's a great point. And speaking of stocks, I know Google's going to have earnings this week. I was thinking about this. I think the new acronym for the market, or at least it has been for the last year, it's no longer FANG. It's MAGA, right? And that's Microsoft, Apple, Google, and Amazon. Those 4 companies are all trillion-dollar companies now. We can get rid of Facebook, get rid of Netflix, because they haven't performed well over the last 6 months or so. And also Facebook at 500 billion market cap, Netflix 150 billion or so. So it's about MAGA, and Google is going to report this week. I took a look back at last quarter's Google earnings, and I went through their conference call, which is what I like to do. One thing really stuck out to me, and that is that the CEO said that Google is evolving from a company that helps people find answers, is what you think of Google, to a company that helps you get things done. And I thought that was a really interesting kind of business change for Google. What are your thoughts on that? That Google is no longer helping you find answers as much as helping you get things done.
Yeah, I think that's actually a big improvement for Google. My concern about Google for years, obviously it's been a great stock for people to own, so it's not a criticism there. But strategically, it's like for a long time they had all these big bets out there on these like so-called moonshot projects on certain kinds of robots, and I think they're still doing the the autonomous vehicles and all that. But if you're an investor, you want to know that there's a payoff, hopefully in terms of profits, bigger profits for your company, if you're going to focus a lot of your resources, a lot of your capital into these new ideas. And quite frequently, it takes years for them to come to fruition if they ever produce a business or profits at all. So I think this is a newer, more serious version of Google. And I think that it bodes well for the company. They have great cash flow, obviously good earnings. Just focus on what you do well. And I think this is an example of it.
Yeah, but one thing I would note for our viewers, and I want to pull this chart up right now, and this is basically their forward price earnings ratio. We talked about this with Apple last week, where this is how you want to value what the company is. Don't worry about the stock price, worry about how is it priced versus how much money they're making. And it's really at the top of the range. It trades at about 27 times forward earnings. I would say around 20 times it becomes more of an attractive play. I don't know why. I mean, I know why. There's been a major multiple expansion in the market, and that's why the market's gone up. It's not because earnings have gone up year over year. It's because people are willing to pay more for those earnings, or investors are willing to pay more for those earnings. So, when it comes to Google, it's the same thing I said about Apple, where Apple was trading at 24 times forward earnings, and they're usually trading at 14. Here you've got Google 27 times. It usually trades around 20. If you can get it between 15 and 20, that seems like a great discount. I don't know. I would stay away from Google stock right now. I think there are more fast-growing tech companies that you can buy that aren't trillion-dollar companies turning into these utilities. But I like the company. I just don't think I would pay the valuation they're asking right now for what.
I wouldn't disagree with that, Ian. Like you said, the valuation-wise, it's at a high level. You would be wanting to wait for a pullback. If the one we're in right now gets a little more serious, maybe it'll skirt the sort of the top of that fairly valued range, and you'll buy it at a better price. And I'm just speaking just generally about Google as a company. And who knows, I would love to see Google with their cash flow pay a dividend. They would attract a whole bunch of new kinds of investors, income investors, rather than, the traders and the Wall Street institutions that are kind of coming in and out of these stocks more frequently. So there's a lot to speak of with this new version of Google that we may be beginning to see. Just one of those things you want to watch. When there's a bigger pullback on the stock, then you can jump on it.
So I'm going to counter that point, because I think if Google decides they're going to pay a dividend, that's a signal to growth investors that they're not going to aggressively invest in growth, and maybe there aren't companies that they can acquire to help them grow. Once they start paying a dividend, I mean, you're going to pay 27 times earnings for another utility company.
But think about this, Ian. I'll just take the other side of it. Mm-hmm. They're going to be using that prodigious cash flow of theirs, not just to pay a dividend, but they can also, buy back a lot more stock and do the sorts of things that we saw Apple, to go back to what you're saying about Apple a while ago. Apple went through this process, 4 or 5 years ago, and Carl Icahn and some other activists bought the stock and basically said, hey, Apple, start using some of your cash to pay a dividend. You know what? It didn't really hurt Apple to pay a dividend. It just attracted more people into the stock and made the case for this sort of solid gold cash flow system that they have. I think there's a case to be made about Google on this as well.
Yeah, that's a great point. And I'm glad that we were able to discuss that this week. So I want to thank everyone for joining us. Jeff, thanks again for joining us on the Market Insights webinar. If you could please subscribe to our video below, give us a like if you like the content, and always feel free to make a comment. I'm Ian King, and for my friend Jeff Yastine, have a great week, and we'll speak to you next week. Thank you.